practical comparison of two jurisdictions that are now shaping the European MiCA landscape in real time. And I would say two of the most hot ones. It's Lithuania and Cyprus. This session is not a general introduction to MiCA. It's more like a strategic analysis of how these two jurisdictions are implementing MiCA, how they differ in regulatory practice, and what this means for companies preparing to operate or, let's say, expand across the European economic area. We will look at the actual evolution of both regimes, examine the recent case of Revolut obtaining its MiCA license in Cyprus, and we will explore Lithuania's transition from its large, huge VASP framework toward full CASP licensing under the Bank of Lithuania. My goal is to help you understand what each jurisdictions offer, what each expect, and how to make informed decision if you are considering MiCA licensing or planning your regulatory roadmap, let's say. By the end of the webinar, you should have a clear sense of how Cyprus approaches MiCA and why it has already licensed major players in this field, how Lithuania is adapting its earlier VASP ecosystem into a stricter MiCA-aligned environment, and what type of company fits better in each jurisdiction based on scale, risk appetite, and operational priority. But before we dive into the specifics of Cyprus and Lithuania, I want to set a clear baseline. MiCA is now the central regulatory framework that defines how crypto businesses operate across the European economic area. It does not replace national financial regulation, but it standardizes the rules for crypto asset and for companies, of course, that provide crypto services. So let us briefly outline the essentials. First, MiCA creates a unified regime, what's called a unified regime for crypto assets that were previously regulated through fragmented national law. It introduced a common authorization process for crypto asset service providers, or CASP, and it brings clarity to areas that were previously, let's say, uncertain, such as, for example, custody, trading platforms, exchange services, advisory services, and of course, crypto transfers. Second, MiCA creates three distinct regulatory categories: one for asset reference tokens, one for e-money tokens, and a separate regime for CASP licenses. And depending on the business model, a company may fall under one, two, or all three regimes. But for most market participants, CASP authorization will be indeed the central element here, and that's what we're going to talk about today. And third is that MiCA introduced passporting. Once an entity is licensed in CASP, as a CASP or a crypto asset service provider in one of European Union or European Economic Area member state, it can provide services across all 30 countries without having to obtain separate approvals. This is what makes the choice of home jurisdiction so strategic. It's not only about where to incorporate, it's first of all, I would say, about which regulator you will work with for the long term of your business. But when we look at the realities of this MiCA implementation, one challenge just stands out immediately. For early stage crypto companies in the European Union, the cost and complexity of attaining a license has become one of the biggest practical barriers to survival. Under MiCA, becoming a crypto asset service provider is no longer a quick administrative step, how it was before. It now requires indeed significantly more time, more documents, and far more regulatory coordination than before. In practice, approval timelines have stretched to let's say 6 months, most of cases even longer. That's almost 3 times what many founders were used to under previous national regime. And this slowdown is driven by additional checks, additional reporting, and much more intensive review process. The financial impact is equally serious. Before MiCA, a small startup could register in a crypto-friendly country, like Lithuania, for example, and meet some AML obligation with a budget of roughly 10,000 euro. But today, initial compliant costs are closer to 60,000 euro and even more. uh, Legal support, audit, capital obligation, internal policies, ongoing administrative requirements are all add up. For many early stage teams, it's simply unaffordable, let's be honest. And what it leads, they pause operations, shut down, or just start exploring relocation options. And this result is very visible in numbers. For example, as of early 2025, across the entire European Union, only 12 crypto service providers and 10 stablecoin issuers have secured full MiCA authorization. It's remarkably low when we consider that thousands, not hundreds, thousands of crypto businesses operated in Europe before this regulation came into force. Even with more applications expected later, because there is still this transition period in most of countries, projection shows that by the end of 2025, and we're already quite close to this date, only around 100 firms will actually obtain a license. So in other words, the vast majority of existing startups will likely remain unlicensed and they just face real limitation on their ability to operate. But there is always but. It's important to know that larger players view MiCA differently. For them, a single EU-wide, European Union-wide license just simply removes the need for separate approvals in every member state, and it offers direct access to full European market. We were just talking about this passporting. This explains why several large global exchanges have already shown strong interest in MiCA licensing. But for smaller teams, the one size fits all model create a just disproportionate burden. Capital thresholds and audit duties quite hard to meet. And instead of building products, founders now need to spend increasing amount of time preparing documents, policies, and report. But even when a crypto startup managed to navigate MiCA and clear the licensing hurdles, it often encounters far more basic challenge. In many cases, it cannot obtain a bank account at all. Across Europe, crypto companies consistently, and that's what we find all the time, they consistently report difficulties both in opening accounts and in keeping them open. And this pattern has become so widespread that the industry now refers to it simply as a crypto debunking. But why does it happen so frequently? The thing is that European banks operate under quite strong regulatory expectation to treat crypto clients as high risk ones. The European Central Bank and several national competent authorities have repeatedly warned about fraud, money laundering, and volatility in the crypto sector. There is no formal prohibition on serving these firms, I mean, crypto companies, but many commercial banks respond with extremely strict internal policies. They often require heavy due diligence, just hugely heavy. They impose high fees or just simply decline to onboard these clients. Some industry observers have compared this approach to the debates in the United States around this Operation Choke Point, where banks were allegedly encouraged to cut off certain industries. In Europe, this issue remained relatively quiet for years because there was quite little official monitoring or disclosure of how many startups are affected. But the operational impact on young companies, it's immediate. Without a bank account, a startup cannot pay employees, cannot pay invoices, or handle fiat transactions with customers. And any routine operation becomes nearly impossible when euro transfers are blocked. Some founders, of course, use personal bank account as a temporary workaround, but this raises compliance and liability risk of itself. Others rely on crypto-friendly intermediaries. So these partners often set strict limits or usually higher fee. And even when startup finally open an account, it does not mean the difficulties are over. Transfer may be delayed or flagged by compliance team. Daily limits may be unusually, unproportionally low, and transaction fee may be high. On top of that, many founders report IBAN discrimination in this field, where a perfectly valid IBAN from another EU member state is questioned or refused because just counterparties suspect it's linked to crypto activity. So in practice, the risking by bank leaves many EU crypto startups effectively unbanked. And until this gap is addressed, the promise of unified, this innovation-friendly MiCA market remains limited by the absence of reliable banking access. But this timing of MiCA implementation, it create, excuse me, can you see the timing slide? Yes, timing. Why timing matter here? The timing of MiCA implementation also create quite interesting, I would say, dynamic. Also, MiCA became applicable at the EU level from December 2024. Each member state is moving through its own transitional arrangement. This means that some regulators are already fully aligned with MiCA. They process full CASP application, crypto asset service provider application, while others are just finalizing their domestic frameworks or granting some transition period to already registered VASP virtual asset service providers. This uneven rollout has created a temporary competitive landscape between jurisdictions because some have moved quickly and decisively, building internal teams, developing guidance, processing early files, while others have taken more time to adapt, to organize all the supervisory processes. And this brings us to the core question of today: why exactly Cyprus and Lithuania stand at the front of this regulatory race? Because that's, I would say, requests that we get from our clients the most. And if you simply Google something like MiCA license and obtain European Union, almost every single article will tell you Cyprus and Lithuania is here. But why Cyprus and Lithuania? Both jurisdictions have something in common. They both, I would say, were already significant crypto and fintech centers long before MiCA. Cyprus attracted a large numbers of investment firms, brokers, and trading platforms. Lithuania built one of the largest VASP ecosystem in the European Union and developed quite strong reputation for payment institution and e-money licensing. But their paths under MiCA fully differ. Cyprus made a strategic decision to shift fully into the MiCA era. It discontinued its old CASP regimes entirely, and it began accepting only MiCA application at the beginning of 2025, so the beginning of this year. Lithuania followed another trajectory. It kept its VASP regime temporarily, but aligned its national law with MiCA and created a full CASP authorization route under the Bank of Lithuania. It extended the transitional period for existing VASP until 2026. January 1st, 2026, everyone should be or CASP licenses or leaves the country. And this transition basically gives the market more time to adapt, but it also signals a clear message that MiCA compliance is no longer optional. So, in other words, Cyprus represent regulatory readiness. Lithuania represent regulatory transformation. Both approaches draw significant interest, but from slightly different type of companies. With this background established, we can now move deeper into this first case study I mentioned before and examine how Cyprus approached MiCA through the example of the Revolut license. Let's begin with this most visible development in MiCA landscape so far, Revolut's authorization as a crypto asset service provider in Cyprus. This case is important, I would say, for two reasons. First of all, Revolut is one of the largest and most recognizable fintech brands in Europe, which means their regulatory choice set a strong signal to the market. And second is that Revolut is among the first major companies to receive a full CASP license under MiCA, not under older national regime, not a VASP or old style sort of CASP. This gives us really real insights into how Cyprus is handling the new requirement. In 2025, CISAC granted Revolut this Digital Asset Europe Ltd, MiCA CASP license. And this authorization allowed Revolut to provide regulated crypto asset services in all 30 EEE countries, European Economic Area countries, through a single supervisory point in Cyprus. As a part of this alignment with MiCA, Revolut is migrating its European crypto clients into the Cyprus entity, and new crypto terms and conditions are being rolled out accordingly. In other words, Revolut has redesigned its entire EU crypto framework to be MiCA native, not to be MiCA adapted. But why is this case such a milestone? It demonstrates that Cyprus is prepared to license complex, large-scale companies under MiCA, because Revolut is not a simple crypto startup. It's a multi-jurisdictional fintech with strict internal governance, high transaction volumes, and advanced risk system. And for CISAC to license such a company early in this MiCA cycle means the regulator has already built internal processes and is confident in applying this new framework. It also signals to the wider market that Cyprus is willing to take the lead in Europe. This matters for every CASP applicants because regulators often watch each other between jurisdictions, between countries. And once a major license is issued, it creates a precedent for the interpretation of requirements and the level of documentation expected. And finally, for the industry, this Revolut case is a clear message that MiCA is no longer some theoretical framework. It is active, it is operational, and large regulated entities are already coming under its scope. And now that we have looked in the Revolut example, let's examine what Cyprus is doing at a structural level. The separate regulator, CISAC, made several clear strategic decisions early in the MiCA timeline. And those decisions help position Cyprus as one of the most MiCA-ready jurisdictions in Europe. The first decision was to discontinue the previous national CASP registration regime that existed under the AMLD5 framework. This regime was, I would say, relatively light, and it served the early stage of the crypto industry. But with MiCA coming into force, Cyprus made a clean transition. It closed the old regime and shifted all attention to full MiCA authorization. And second decision was to accept only MiCA application from the beginning of 2025 because it created clarity for the market. Any applicant approaching SciSec know they must prepare a complete MiCA package from day one. There is no pathway to enter the market through an easier temporary regime, like, for example, in Lithuania. We'll talk about this later. It's a fully compliant MiCA environment here in Cyprus. But let me outline the more practical requirements and the process that SciSec expect applications to follow. MiCA applicant in Cyprus must first, of course, establish a local legal entity. They need to maintain a physical office and demonstrate real operational substance. This includes the appointment of local director, resident AML officer, and a governance structure that reflects the scale and complexity of the intended service. SciSec applies MiCA governance requirements in full, and the independence and competence of the management team will be, I would say it can be, and it will be examined from the very beginning. So the documentation package is extensive. It covers a detailed business plan, operational and compliance procedure, AML and QAC framework, IT architecture, cybersecurity policy, outsourcing arrangement, and risk management system. SciSec reviews these materials really thoroughly. And the Revolut authorization demonstrates that the regulator is able to assess, to evaluate the sophisticated and highly integrated operational models. From a process perspective, everything begins with identifying the exact crypto asset service that the company intends to provide under MiCA. This definition determines the entity structure, capital requirements, and the scope of the entire application. Once the services are defined, the preparation of the application documents begin. The core of the submission is a SciSec MiCA application form under Article 62 and its annexes. In practical terms, this involves providing general information about the applicant, its group structure, and requested services. It also requires a 3-year program of operation and a business plan that explains the business model, target markets, resources, outsourcing arrangement, and expected cross-border activity. Also, applicants must also present their prudential safeguard and a capital planning describing how minimum capital and ongoing own fund requirement will be met and monitored. A governance document form also significant part of the submission. Applicants must demonstrate the adequacy of their internal control framework, compliance arrangement, and business continuity planning. They must also outline their AML and sanctions framework and formally appoint an AML officers resident. As far as you remember, I mentioned it already. SciSec will assess all directors also and key function holders to verify their fitness, experience, and time commitments. Shareholder with qualifying holding must also be disclosed and must also be documented. On the technical side, the applicant must provide ICT and security arrangement considering with DORA and general cybersecurity standards, and where relevant, additional documents that must demonstrate, let's say, the segregation of client assets, compliance handling procedure, custody policy, execution policy, advisory procedures, portfolio management procedure, or let's say transfer service arrangement. To support this package, CITEC expect a full set of corporate certificates, constitutional documents, group structure chart in the company, and as a group of companies, there is more than one. Financial forecast, of course, evidence of paid share capital, internal policies, and manuals covering all operational areas, directors and shareholders, and complete outsourcing register. After all this documentation is prepared, the application is submitted and the CISEC fee is paid for custody and administration services. The application fee in Cyprus and CISEC for application it's 10,000 euro. Also, this amount, as it varies depending on specific services for which the applicant take authorization. These fees are not refundable, even if the application is withdrawn or rejected. Fee is non-refundable. But once the file is submitted, CISAC begins its assessment and it may request clarification of some additional document. In general, during this assessment phase, any question raised by CISAC must be addressed promptly until the application is considered complete. So during this review process, they may reach out to you. That's why the QEC information is important to by the form should be filled in correctly to put all your contact information to react promptly, quickly to any additional request CISAC may have. But once authorized, the company can operate in Cyprus and may passport its services across the European Union through a standard notification procedure. Under MiCA, initial capital requirements, it's also one of these MiCA compliance requirements. It's mostly depend on the services applied for example, advice, reception and transmission, or execution of orders require 50,000 euro. Exchange or custody services require 125,000 euro. The operation of trading platform require 150,000 euro. From a second year onward, CISEC charge annual supervisory fee, also additional fee. It's based on the services offered against custody and administration trigger early fee of 10,000 euro. Trading platform operation require 20,000 euro. Exchange services require 5,000 euro, a bit less finally, and advisory services require 8,000 euro. Variable fee where annual turnover exceed 500,000 euro, subject to an overall cap of 500,000 euro. In terms of timing, CISAC acknowledge receipt of the application within 5 working days and confirms whether the file is complete within 25 working days. Once the file is considered complete, CISAC must grant or refuse authorization within 14 working days. Taking into account the preparation phase, quite realistic timeline for an end-to-end MiCA authorization is between 6 and 10 months, depending, of course, on the complexity of the business model and the applicant's ability to provide information without delays. Legal fees for a complete MiCA CASP application handled by a local lawyer in Cyprus. We did this research to obtain this information. It's usually start from 25 to 35,000 euro plus VAT. And the final amount, of course, depends on the services requested, the number of policies that must be drafted from scratch, because maybe some policies are already in place, and in general, the overall complexity of the structure and the engagement. The combination of this factor create a very disciplined regulatory environment. However, it also provides predictability. Applicants know what to expect. They know which documents must be ready and in which form. They also know that Cyprus has already processed files of high caliber, which helps to set expectations for the entire market. Cyprus is therefore emerging as a strong hub for companies that want a serious, structured, and fully aligned MiCA authorization. So let us summarize the main insight before we move to Lithuania. First, Cyprus has demonstrated real regulatory readiness. The Revolut case shows that CySAC is not only prepared to apply MiCA, but also prepared to license large-scale operations under early in the cycle. Second, Cyprus is an attractive home jurisdiction for companies that plan to operate across the entire European market. Its experience with investment firms, with trading platforms, give it a strong foundation to supervise crypto services under MiCA. And third, its expectations here are actually quite high. Um, Substance here is not optional. Governance here must be robust. Documentation here must be complete. Cyprus, it's not the easiest jurisdiction, it's true, but it is one of the most clearly structured. And finally, Cyprus sent a very important sign to the market. MiCA is now a live regulatory environment. It's not aspirational, it's operational. Companies that prepare seriously and early can obtain authorization and position themselves strongly across Europe. So, with this understanding of Cyprus, we can now turn to Lithuania and see how a different regulatory path is unfolding under this MiCA framework. But before we analyzed how Lithuania is implementing MiCA, it's important to understand the foundation it's building on. Lithuania entered the MiCA era with one of the largest and I would say most active and attractive VASP ecosystem in the entire European Union. For several years, the country operated a national registration regime based on AML-T5, which allowed crypto companies to offer exchange and custody service under a relatively clear and accessible regulatory framework. This VASP regime became extremely popular. Hundreds of companies, both local and international, registered in Lithuania. Firms were attracted by, of course, transparent rules, clear expectation from the authorities, and a regulatory environment that was familiar with fintech models due to Lithuania's strong history with payment institution and e-money institution. Lithuania gained a reputation as a crypto-friendly jurisdiction for, I would say, several practical reasons, not without reason. First of all, national VASP registration was structured and predictable. It required proper AML policy, local representatives, and a compliance oversight, but it did not impose the full supervisory burden on a financial license like it's now under MiCA. Second, the country already had a well-developed digital and fintech ecosystem. Many founders Overbuilding crypto products also needed to access the payment services, AMI partners, and banking infrastructure, all of which were easier to find in Lithuania than in many other EU markets. However, I would say the very success of the VASP system also brought challenges because the large number of registered companies led to increased scrutiny from European authorities who questioned whether the national AML-based regime could keep up with this evolving risk landscape. It became clear that Lithuania could not rely on the vast framework indefinitely. And this and transition to a stricter, harmonized MiCA regime was just inevitable. By the time MiCA entered into force at the EU level, Lithuania had one of the biggest crypto population in Europe, but also one of the strongest incentives to shift from a simplified registration model to a full supervisory model, MiCA CASP. In this context is crucial. Lithuania did not start MiCA from zero. It started from a large, active, but unevenly mature industry that now had to be aligned with much more demanding European standards. With this in mind, let's look at how Lithuania is implementing this MiCA in practice, what change companies in the jurisdiction are experiencing. Um, the thing is that Lithuania introduced its national MiCA legislation in 2024. The CASP program is already in effect. It's already working alive, supervised by a Bank of Lithuania. This means that company must now prepare a full authorization package that mirrors MiCA expectation. It's not an update of the old VASP system. It's completely different class of regulatory scrutiny. So Lithuania granted existing VASP a transition period ending on January 1st, 2026. So less than 2 months now they have. And still, take into account that Lithuania introduced its national MiCA legislation in 2024. This is one of the longest transition periods in the EU. It was introduced because the Lithuanian VASP ecosystem is large, it's diverse. Many companies registered early with minimal operational complexity and absurd termination would have created, I would say, market instability. In effect, the transition period functioned as some sort of a probation phase. It's an opportunity for companies to demonstrate that they can evolve into fully regulated entities. This regulatory culture in Lithuania has always been data driven and process focused, especially given the country's long track records of supervising payment institution, different e-money institution, and this experience directly shapes how MiCA files are now reviewed. So let me break down this expectation into a few core areas. Uh, Governance and management. Companies must present a clear organizational structure with identified responsible person. The regulator examines the competence and independence of management, evaluate the conflict of interest, and require documented decision-making processes. Governance under MiCA is not a formality. It's a key factor in this authorization decision. Before MiCA, you needed 125,000 minimum share capital to form a crypto business in Lithuania. If you register your business under MiCA now, you must have a minimum share capital going from 50 to 150,000, depending on the business model and risk profile. But also, you must budget for AML, QAC, and SFT compliance, audit procedure, regulatory reporting, consumer protection, of course, constant employee certification and license renewals. All of those costs mostly will depend on your business type and your business size It's hard. It's really hard to try to evaluate it as an approximate numbers. Regarding AML, the Bank of Lithuania has always been strict on AML. Under MiCA, the expectations are even higher now. Companies must provide complete AML policies, transaction monitoring procedure, escalation processes, and staff training framework. The regulator also evaluates the technical tools used for monitoring and checks whether they match the scale of the business. A licensed company must hire a qualified IML officer, compliance officers. It's also known as money laundering reporting officers, to communicate with FICs and inform the regulator about suspicious transaction. A candidate for the position of an AML officer must meet certain requirements. It must have the knowledge and competence, of course, in the IML SFT field. It should speak sufficient Lithuanian language and understand the Lithuanian legislation. Third point is risk management. This is a substantial change for many former VASPs. MiCA requires documented risk inventories, methodologies for assessing risk, and internal control that match the nature of the service. Operational risk, market risk, IT risk, outsourcing risk, and cybersecurity risk, it all must be addressed. The Bank of Lithuania also examines the system architecture, access control, data protection, incident response procedure, and business continuity arrangement. And companies that previously operated with lightweight or outsourced IT structure now required to demonstrate significantly stronger internal capacity or, let's say, at least well-managed third-party arrangement. Customer documentation, the last point, terms and conditions, of course, risk disclosure, complaint handling policy, conflict management framework, all must be fully aligned with MiCA. The regulators indeed examines not only the content, but also the clarity and fairness of the document. What is happening in Lithuania right now is a real shift in how the crypto market function under MiCA. For years, many VASPs operated with very light internal processes. Some had minimal governance, limited compliance, and almost no real structure behind them. Under MiCA, that model simply does not work anymore. Companies now face a clear choice. Either they build proper internal capacity or they just step back from the Lithuanian market. And this moment is already filtering the industry because smaller players or those who came to Lithuania only for quick EU access, they may not make it through the transition. But at the same time, it's not so bad. Something positive is happening as well. Lithuania is becoming more stronger, more credible jurisdiction, and firms that already have mature internal systems suddenly stand out. They are no longer competing with hundreds of lightly structured entities. The market is starting to feel different. Less noise, more substance, less quantity, but more quality. There are also some very attractive features on paper. Lithuania does not require, for example, a list office. There are no separate ongoing supervisory fee for crypto companies, and MiCA authorization is issued indefinitely. Also, and foreign founders or directors are fully allowed, even if they are not EU citizens. These points look genuinely founder friendly, and for many teams, they sound almost too good to be true. But here is where the picture became more complex. If you look at the National Register of Lithuania, you will find something interesting. 45 EU and EEA, European Union and European Economic Area, crypto asset service providers already serve Lithuanian clients without having any establishment in Lithuania at all. A company like, for example, Revolut, licensed in Cyprus, or Bybit, licensed in Austria, operate here in Lithuania through passporting. And when you try to check how many companies actually received the MiCA license in Lithuania itself, this information is nearly impossible to find. The only clearly confirmed case is Robinhood Europe. They received both the Lithuanian in-category brokerage license and new MiCA CASP license, which basically gives them permission for custody, transfer service, order execution, and order reception. It also replaced their older national VASP authorization and gives them full EU coverage. It's a big milestone, but so far it's the only one that is publicly visible. Take Binance, for example. They had a VASP license in Lithuania, but there is no public confirmation that they transitioned to MiCA CASP license. And if you talk to local advisors in Lithuania, you will hear the same thing. Informally, everyone repeats that at the moment there are only one company that successfully obtained the new license in Lithuania. Yes, of course, many may still be in process because we remember deadline January 2026, deadline has not arrived yet. But when numbers are this low, I think they are sending a signal. I cannot formally sign under these words, but Lithuanian experts say it very directly. The current governmental approach is to license only the big established players. And startups and small crypto companies are not in the spotlights right now. Um, that's how the real landscape look like. On paper, Lithuania look open, flexible, and welcoming. In practice, the bar is high, and the entry point seems designed for serious, well-structured firms rather than early-stage teams. For strong players, this makes Lithuania quite credible EU gateway. But for young startups, the journey may be more challenging than expected. In summary, Lithuania is moving from being a jurisdiction known for ease of entry to becoming a jurisdiction known for regulatory maturity, I would say. And this shift will have long-term effects on how the European crypto market develops as well. Now that we have looked at Cyprus and Lithuania separately, I'd like to bring them together in one comparative frame. The goal here is not to declare a winner. This one is better, this one is worse. The goal is to just understand how each jurisdiction position itself and what type of company is likely to fit better in each environment. I will go through 6 key dimensions that are usually decisive when founders and board choose their MiCA home state. And first, it's regulator and supervision experience. First, let us compare these regulators themselves and their supervisory background. So on the Cyprus side, the competent authority is CISAC. It has long-standing experience with investment firms, brokerage houses, forex platforms, trading infrastructure. This means CISAC is very familiar with high-frequency trading, with leverage products, with cross-border services, and complex risk profile. And this experience naturally translated into more investment market-oriented view of crypto service providers. On the Lithuanian side, the supervisor authority is the Bank of Lithuania. Its strength lies in payment institution, e-money institution, broader fintech supervision. But the regulator that has built a strong reputation for its work with payment flow, consumer protection, in money services, in payment institution field, show themselves indeed more big in the field of crypto regulation, more strong in the regulation, but for more big as an option, especially for startups and small crypto enterprises. So at a high level, Cyprus comes from an investment and capital market background. Lithuania came from a payment and fintech infrastructure background. Both are valuable, but they shape the regulatory culture in fully different way. Because second dimension I want to talk about here is the MiCA readiness, it is implementation state. Because Cyprus has fully switched into MiCA mode. Lithuania into still in this advanced but transitional phase. In practice, it means that Cyprus look more binary. You are either MiCA authorized or you are not. Lithuania for the next 2 years continue to have this mixed landscape, but of course with increasing pressure to coverage fully under MiCA authorization because deadline is coming, but still so many companies just work here under the VASP. And until the deadline did engage no one, they still just continue their operation in the country like this. Third dimension is a local substance and local presence. Usually, both jurisdictions require real substance. A purely nominal company with no real operation will not satisfy MiCA expectation in either Cyprus or Lithuania. In Cyprus, substance usually means local director with real decision-making authority. Resident AML officers on the ground compliance, operational capacity that correspond to the scale of service. In Lithuania, the Bank of Lithuania expect a similar level of substance, but it framed through its experience with payment institution. It focused strongly on governance, risk control, ML quality, and more like local accountability. In both places, virtual structure without real people and processes will not work. The choice is less about whether substance is needed and more about which regulatory culture your team feels more aligned with. The first dimension is market perception, especially from investors and banks. Cyprus has been associated with trading platform for a long time, investment firms, brokerage activity. Lithuania is widely seen as a fintech and payment hub. It has hosted many e-money and payment institutions that operate across Europe. And regarding e-money and payment institution, indeed, the Lithuanian regime is more kind, I would say kind, even to startups, to small enterprise. So when we look at these dimensions together, we do not see a simple hierarchy. Instead, we see two different strategic profiles. Cyprus appears as a fully MiCA focused, capital market oriented hub that is ready for large scale and complex structures. Lithuania appears as a transforming fintech oriented jurisdiction that's still in process of reshaping a large VASP ecosystem into more disciplined MiCA environment. In this section, I want to briefly move from theory to practice positioning. Question many founders ask is very simple. Which jurisdiction should we choose for our MiCA license? Of course, there is no universal answer. The optimal choice depends on company scale, internal maturity, business model, and strategic priorities. But to make this more intuitive, I wanted to outline these three typical profiles and explain how each align with Cyprus in Lithuania. So, for example, large fintech or neobank with existing governance and compliance infrastructure. Uh, where do they fit? And our answer is Cyprus is often the natural choice because CySec has long-standing experience with complex financial institutions. The regulator is comfortable evaluating high volume operation advanced risk model. Cyprus license is immediately recognizable to many institutional partners. And Revolut case just has straightened the perception that Cyprus is ready for large-scale play. These companies usually have the resources to satisfy the higher substance expectation in Cyprus without compromising their operational plans, I would say, operational roadmaps. For international crypto startup scaling toward EU markets, both jurisdictions are possible, but the choice depends on the company internal maturity and its risk appetite. Because what we already understand about Lithuania, small enterprises and startups are almost impossible to enter the market here. That's why Cyprus, if we choose between these two options, fits well if the company wants strong brand positioning, has or is willing to hire senior governance and compliance roles, and ready to meet high documentation and IT requirements early. In practice, however, for small startups, it makes more sense to consider other MiCA jurisdictions such as Poland or Czech Republic, Austria. Of course, it's all a case based. And last but not least, regional players with local or niche focus. I added here Baltics, the EU, Nordics. Of course, where do they fit better? Lithuania, typically is a more natural choice. Its reasons include this mature fintech ecosystem with existing partnership in payment and compliance, regulatory cultures that recognize the dynamic of regional digital financial service. I would like to say also the ability to build MiCA compliance step by step during transition period. Let's be honest, it's too late for this as of now. So across these three profiles, the pattern became visible. Cyprus aligns strongly with companies that already resemble regulated financial institutions in their internal structure. That does not mean that a growing startup cannot choose Cyprus. It's possible. But understanding your internal strength and the expectation of each regulator will allow you to select a jurisdiction that supports your long-term strategy, not only your immediate licensing. I had also a few slides about MiCA readiness, what you need to know before you apply. But I see we are very much out of time. So, as this matter of MiCA readiness, what you need to know before you apply, how to clarify the exact MiCA services you will provide, how to build a robust governance structure, competent board of management body, clear separation of function, how to straighten your IML and compliance framework. We can talk about this next time during our next webinar that will be dedicated exactly to this topic. But before we wrap up, I would like to open the floor for questions because we covered a significant amount of material today, from regulatory context to jurisdictional comparison to practical preparation steps. If there is any point that you would like to explore further, or if you would like clarification on how certain requirements apply in practice, this is a good moment to discuss it. We don't have much time, but please feel free to share your question, either broad or very specific. I see there is some message in chat. I will share all slides that we saw today. Regarding the slides for MiCA application, I believe in next few weeks, we will have one more webinar where we will go into more details about this, because on this slide, we touched more like general. We will come more deep. And of course, after this webinar, we will share all slides with you. So please stay tuned and check our LinkedIn of legal notes, and we will share information when this webinar can be expected. Thank you for information. Thank you very much. Thank you for your question. Thank you for being here and thank you for your attention. I appreciate it a lot. I would be happy if you'll come to next webinar as well, where we come in more deep topics. Thank you for joining today's webinar, for your engagement throughout the session. I hope this comparison and the practical guidance and these insights we obtained from the jurisdiction, especially from Lithuania, because we believe it's important to find this information. It's impossible to find this information in Google, on LinkedIn, on anywhere else. That's why our team went directly to Lithuania and we had direct communication with regulator, with a representative of a Ministry of Communication and Office of European Commission to understand how it will work, to share it with you. So no one will be surprised and pleasantly. There will be time to choose a jurisdiction for them. Thank you very much. I hope this comparison and practical guidance help you navigate your next steps under MiCA in more structured way. If you would like to continue the conversation, discuss your specific business model, or explore which jurisdiction aligned best with your strategy, please feel free to reach out to Legal Notes. We'll be glad to assist. Thank you once again, and I wish you a productive remainder of the day. Let me
Thank you,
stop her
everyone.
screen.
Bye.
Thank you very much, Victor, for hosting this event. Bye, everyone.